Great to have you both, Savita. I'll start off with you. 2,900 is your target. It does feel like the market's sort of tired here. We've been pretty much flatlining for the past at least month. So where are we here? What does a contour of 2,900 look like to the end of the year?
Yeah, I mean, obviously not a straight line, but our target for year-end is 2,900. So at this point, I feel relatively neutral on equities. I think a lot of the easy gains for the market are in the stocks, and we saw this complete round trip in equities over the last couple of quarters. From here on out, I think what's more interesting is the internals of the market. So I think what's really fascinating right now is that the world is still very defensively positioned, but cyclical sectors and stocks look like they could actually have a pretty great second half. So where we're putting our money at BofA Merrill is on cyclical sectors, industrials, consumer cyclicals, tech, old tech, not new tech, so more cyclical tech rather than secular tech. But the market overall, I mean, what I worry about for the next couple of years is that share buybacks kind of seem to be fading out a little bit, and those have contributed a huge chunk of earnings growth over the last 5 years. Like 30% of earnings growth over the last 5 years has come from companies just buying back their own.
Why do you think the share buybacks go away?
So I think they go away because, A, investors don't want share buybacks anymore. So in our own surveys, we found that, you know, a huge proportion of investors want companies to pay down debt at this point rather than use that money to buy back shares.
Is that defensive psychology in this part of the cycle? Are they worried?
Well, I think part of it is that they're worried because leverage ratios are fairly extended. And then the second reason is that the cost of capital on the debt side is starting to creep up a little bit. You've got the Fed off of easy money. You've got credit spreads at all-time lows, you know, potentially going to move higher. You've got the tax benefit for debt slowly being removed. So I think there are a lot of pressures on debt capital that investors are starting to worry about.
I would imagine that this would be a greatest concern, Jurrien, when you take a look at the different kinds of companies in the market amongst small caps, which have the highest percentage of companies that don't have the free cash flow to pay down their debt. Is this sort of a part of the market, Jurrien, that's signaling? Is it like a canary in the coal mine? Should we be watching this very carefully?
I think buybacks will probably continue, and for many companies, it's just a reflection of that they generate a lot of free cash flow. You know, free cash flow as a percentage of sales for the S&P 500 is about 10%. Even after dividends, it's still 6%. So the numbers are very healthy. I mean, not every company is loading up on debt in this sort of form of misallocation of capital and generating sort of, the illusion of earnings. I mean, earnings per share, I think I agree, are overstated, possibly by about 20% or about 15%, sorry, $20 per share, because as companies buy back shares, they shrink the float, and so the ratio of sort of earnings per share against the dollar earnings goes up. So I think that is a real thing. But then the question is, how do you value the free cash flow? And I think that doesn't really show up in the typical metrics. So I think investors will continue to discriminate between companies that generate enough free cash flow that even after satisfying dividends and even after CapEx, they can still buy back shares. And I think, as you point out, we're starting to see that distinction between those who can do that and those who cannot. And the change in leadership is part of that story.
Did you say $20 a share in earnings on the S&P 500 is because of buybacks?
In terms of earnings per share.
Yeah.
It's a big number, but if you think about it, since the global financial crisis, the S&P is up 4.7-fold. If you strip out that $20 per share, it still would be up 4-fold, which would still be an epic bull market. So it's a big number, but it doesn't really change anything directionally.
I think, though, the one thing that we all forget, or that I forget frequently, is that pre-crisis, companies didn't generate earnings from share buybacks. In fact, shares increased rather than decreased. So I think this is really just a last 5 years phenomenon where the hurdle rate has been super low, capital has been free, and companies have basically been incented to buy back shares.
So if you think 30% of the market right now is being boosted, artificially or not, depending on how you want to think about that, by buybacks, you think it comes down to what on average in the next 2 years?
So going forward, we're modeling no benefit whatsoever.
Zero. So from
buybacks.
30% of the market to zero.
Which is kind of what we experienced prior to the crisis, no buyback benefit, because most of the time buybacks were simply done to offset compensated related dilution.
I mean, you're still
right?
going to have companies that have a lot of cash on their balance sheet.
Sure. I think you're going to still see buybacks from big tech, financials, and those companies are probably going to do a lot better than the rest of the market because they're the scarce resource.
Is that for part of the reason that you say that you like to focus on those areas too?
Absolutely. I think that financials and tech are the cash return sectors going forward. And the rest of the market looks a little bit less exciting that way.
Jurrien, just to wrap it
I
up.
would just-
go
I
ahead. Go ahead.
Yeah, I would just add that in the old days, half of the S&P return came from dividends. It was around 5%. These days, it's 2%. You add in cash buyback, add in share buybacks, adds about 3%. You get back to 5%. So I think there are problems in pockets of the markets, but by and large, I think this is just a way to return cash to shareholders, to bring that cash yield back to 5%, which is where it used to be in the old days before dividends sort of went down to 2%. So it really comes down to free cash flow. The companies that generate it, they can do their capex, pay their dividends, and still buy back shares. That to me is a fairly benign phenomenon.